Let's talk about the RSI indicator, the Relative Strength Index. Now, as with any technical indicator out there, this should not be used as a standalone indicator. You need to use it in conjunction with other indicators, perhaps some price action, support and resistance, and so forth. Now, I always say that no indicator has got the magic. No indicator is the holy grail. But it's important that you know about the RSI so that you know whether you can incorporate it into your strategy building or not. It's certainly something you may want to consider. So let's go into this now. I do also know that many of the big banks, I read all the bank reports, a lot of them talk about the RSI indicator in terms of being overbought, oversold and all that. So I think it's important that you know. That's another reason why I want to put this video together. Right, okay, so let's have a look. The RSI indicator was created by a guy called James Wilder back in the 70s. I'm not sure you really need to know that, but there you go. I'll put it on the slide anyway, just in case you're interested. Okay, it is a momentum oscillator. Momentum basically meaning gauging the speed of a move, and it obviously ranges between levels. More about that in a second. But momentum, basically, it measures the speed of the asset's move. Okay, so it measures the magnitude of the asset's gains in relationship to its losses over a certain period of time. In the next slide, I'm going to show you the formula, which might explain that a little bit more. But it's basically comparing the gains in a period over the losses in a predefined period. Okay, the rising RSI, so an RSI that's moving up, that will indicate a rise in momentum. And a falling RSI will indicate a fall in momentum. And when the momentum starts to maybe wane, starts to slow down, that could be indicating a turnaround in that particular trend or in that particular momentum. Okay, it fluctuates between 0 and 100. All oscillators fluctuate. That's basically what they do. They oscillate and they go between 0 and 100. They can't go below 0 and they can't go above 100. But the way we use the indicator, or the way that the analysts, traders use the indicator, is that they have bands. They have bands where markets are considered to be oversold and overbought. So they oscillate, or the indicator key levels that we look at are 70 and 30. Anything over 70 is overbought, in theory. Anything below 30 is oversold, in theory. Okay, the default period that you get when you download this onto your platform from your indicator section normally is 14. I know some like to use a bigger number, bigger default period, and that basically would smooth out the oscillator. But 14 is the default, and it is a leading indicator. A lot of the indicators out there, they are lagging indicators. What do we mean by lagging? Well, basically we means it lags behind the price. It basically shows you what's happened in the past. Whereas the RSI and most oscillators, they're considered to be leading indicators, basically helping you predict where the prices may go in the future. It doesn't necessarily mean one is better than the other, but it is a leading indicator. So this is the formula of the RSI. You don't need to know this formula. It really isn't that important, but if you are mathematically inclined and you want to delve deeper into it, this is the basic formula. RSI equals 100 minus 100 divided by 1, which is minus RS, and the RS is the average of the price increases over a period divided by the average of the price decreases over a period. So what that basically means is, if you have a 14 period, say the default, and say over 8 days, so that's 14 days, so 8 of those days you had a rising market. It averages out the number of pips, basically, that it rose in those 8 days. And it divides that by the other 6 days where it declined.